Well, that's a tough list to choose from. I think for us, Fed policy is something we're arguably much more concentrated on at the moment, because we do believe there's a real risk that the Fed will end up being forced to raise interest rates perhaps a little bit earlier than what markets are pricing in. And to us, that poses upside risk to treasury yields, which has impact on yield-seeking instruments around the world globally. Having said that, from a growth perspective, China is obviously very, very important, almost equally important. And to us, it looks very much like their economy sort of caught in a relatively tight range, as policymakers struggle between achieving growth targets while avoiding excessive credit growth. So we are quite focused on the risk there. And Iraq, finally, to us is more a short-term risk through the oil prices channel, something we're keeping an eye on, but we don't see genuine disruption of supply at the moment. Well, the logical impact would be that if we do see a sustained rise in oil prices, that does pose a lot of risk to current account deficits of the big oil importers. So again, countries like India and Korea, for example, may face quite a bit of pressure on their external balances and therefore on their currencies. Having said that, I think it's important to recognize that much of Iraq's oil production is concentrated on the south and the east, while much of the fighting is in the north. So we haven't actually seen adequate reason to believe that supply is likely to be disrupted just yet. So to me, it's a situation we still need to watch, and without a disruption in supply, the rise in oil prices could end up being short-lived. Well, I think we're seeing a bit of a disconnect between what the economic data is telling us, particularly on the growth side, but increasingly so in the labor market, and what markets are pricing in. And we believe, this disconnect will have to be resolved soon, with either side adjusting. Markets believe the Fed is likely to only hike rates in the second half of 2015. We believe there's a real risk they may raise that sooner, potentially in the first half. And we're coming from really that improving economic data. Growth data is improving, but we're seeing increasing signs of inflationary pressure. Core CPI over the last 3 months, the moving average has annualized is beginning to approach 2.8%. And what would be much more worrying for us is if we begin to see wage growth begin to accelerate from where we are today. And there are some lead indicators that suggest that might be a risk. So we're definitely the camp that the rate hike may come a little bit sooner than what markets expect, and that poses an upside risk for treasury yields.